Welcome back, everyone. Today we're doing a full, deep, but friendly review of one of Singapore's newest income ETFs, YLD, the Lion-OCBC Securities APAC Financials Dividend Plus ETF. If you're a Singapore income investor who loves steady, quarterly payouts and wants exposure to Asia-Pacific's strongest financial giants, this video is for you. YLD has paid around 8 cents in dividends over the last 12 months. That's about a 6.2% trailing yield based on 14th November 2025's closing price of $1.28.5. But is the dividend sustainable? Can it grow? And how will Fed rate cuts in 2026 impact it? So, stay with me till the end, because I'll also share what Singapore income investors should really consider before buying YLD. And if you find this helpful, please like this video so more Singaporeans can watch it, and subscribe to Wealth for You for more Kopi Money dividend content. Disclaimer: this video is for education and entertainment only, not financial advice. Please do your own due diligence and consult a licensed advisor if needed. Chapter 1. What are dividends and dividend ETFs? Before we dive into YLD, let's keep things simple and friendly. A dividend is money a company pays you from its profits, like a thank you for investing in them. A dividend ETF is a basket of dividend-paying companies. Instead of buying 30 or 40 individual dividend stocks, you buy one ETF, and it automatically collects dividends for you and passes them back to you regularly. Very convenient, very fuss-free, and very popular with Singaporeans looking to build passive income. Chapter 2. What exactly is YLD? Now, on to the star of today's video. YLD stands for the Lion-OCBC Securities APAC Financials Dividend Plus ETF. It was launched on SGX on 13th of May 2024. Making it one of Singapore's newest and most talked about income ETFs. So what does YLD actually do? It invests in 30 of the biggest, strongest, and most tradable financial institutions across the entire Asia-Pacific region. We're talking banks, insurers, financial groups, and investment firms that have established track records and consistent dividend histories. And here's the part Singapore income investors love: quarterly payouts. YLD's dividend policy targets 5% per year, based on the $1 issue price for the first 2 years, paid quarterly. From year 3 onwards, around 5% per year based on NAV, also paid quarterly. Of course, this is a target and not guaranteed, but the ETF is clearly designed from the ground up to deliver steady, predictable income, which is why many Singaporeans are paying attention to it. Chapter 3. YLD's Top 10 Components. Okay, so to really understand YLD, you need to look inside its engine room, the powerful companies that actually generate the income for this ETF. Right at the top, you'll see some familiar Singapore heavyweights, DBS Group Holdings at around 7.9%, followed closely by OCBC Bank at 7.6%. These two alone already give YLD a solid backbone of Singapore financial strength. Then we head over to Japan, where the giants Sumitomo Mitsui Financial Group at 7.2% and Mizuho Financial Group at 5.7% add even more regional stability. Of course, our own UOB Bank comes in strong too, at around 6.5%. From there, the ETF stretches across the region: HSBC Holdings at 5.6%, China Construction Bank at 5%, and the trio of Australian leaders, Commonwealth Bank of Australia at 4.3%, National Australia Bank at 3.8%, and Westpac Banking Corp at 3.8%. Put all of that together, and you get a who's who of APAC financial giants, some of the largest and most established financial institutions in this part of the world. But one important thing to note: YLD is 100% concentrated in the financial sector. Very strong names, very stable institutions. but definitely not diversified across other industries. Chapter 4. YLD's Annualized Trailing and Forward Yield. Since launching in 2024, YLD has established a pretty clear payout rhythm. Its first year saw 3 cents per unit in July and 1.25 cents in September. In 2025, the pattern became consistent. January, April, July, and October each paid 1.25 cents per unit, with one special dividend of 3 cents in late July. Altogether, YLD paid 8 cents per unit over the last 12 months. Using yesterday's closing price of $1.28, that gives a 6.22% trailing yield, boosted by the special payout. Now, if we annualize only the baseline quarterly distribution of 1.25 cents, that's 5 cents per year, which works out to a 3.89% forward annualized yield. So, in simple terms, roughly 6.2% if special dividends continue, or about 3.9% annualized if YLD delivers only its regular quarterly payout. Just a quick reminder, the forward yield isn't guaranteed. It's based on the ETF's stated policy and its track record so far. Chapter 5. Future Prospects of YLD. Looking ahead, YLD's income story rests on a few solid pillars. APAC banks, the core of this ETF, have long histories of stable, reliable dividend payouts, with heavyweights like DBS, SMFG, HSBC, and Commonwealth Bank of Australia anchoring the portfolio. YLD stands on the shoulders of some of the strongest financial institutions in the region. Its built-in quarterly payout structure also aligns perfectly with what Singapore income investors love: regular, predictable COPI money. And because the index filters for financially healthy, consistently profitable companies, YLD is intentionally designed to prioritize sustainability over speculation. Of course, there are trade-offs. YLD charges an expense ratio of 0.5%, which is reasonable for a regionally diversified ETF, but still something income investors should factor into long-term returns. And while the foundation is strong, the risks are very real. YLD is 100% concentrated in the financial sector, so if APAC banks face headwinds, the ETF feels it immediately. It also has a short operating history, launching in 2024, meaning we haven't yet seen how it behaves through a full recession or aggressive rate cut cycle. Dividends can also be paid from capital, which may erode NAV over time. On top of that, you have currency risks, from Aussie dollars, yen, and Hong Kong dollars, and different regulatory environments across Asia, each with its own rules, pressures, and surprises. So what's the big picture? YLD is best used as a steady income satellite position, an enhancer, not the hero of your portfolio. It should complement your existing banks, REITs, and broad market ETFs, not replace them. Think of it as a reliable extra tap in your COPI money pipeline, one more source of quarterly income, but not the tap you depend on entirely. Chapter 6. How Fed rate cuts could affect YLD. With global rate cuts on the horizon, it's natural to wonder how YLD, and the financial giants inside it, might react. When the Fed cuts rates, borrowing becomes cheaper, which is good for consumers, but not always great for banks. Lower rates usually mean net interest margins shrink, squeezing the difference between what banks earn on loans and what they pay on deposits. When margins shrink, bank earnings may soften, and that can translate into slower dividend growth across the sector. But here's where APAC, and especially Singapore, stands out. Our banks aren't just lending machines, they're diversified financial powerhouses. They earn big from wealth management, credit cards, insurance, treasury operations, and a whole ecosystem of fee-based services. These income streams help balance out NIM compression, especially during periods of lower rates. And lower rates aren't all bad. They can actually boost loan demand, reduce stress on borrowers, and bring down default rates. In other words, some parts of the business weaken, but others strengthen. So the overall impact on YLD is mixed, not purely negative. You can still expect stable, steady income, but probably with fewer upside surprises if dividends don't grow as quickly in a lower-rate world. Chapter 7. What Singapore income investors should consider. Before adding YLD to your portfolio, it's worth taking a moment to reflect on whether it truly fits your income strategy. The first question is simple. Are you comfortable with concentrated exposure? YLD is entirely made up of financial sector stocks. Strong names, yes, but definitely not diversified across multiple industries. Next, think about why you're buying it. If your goal is a steady stream of quarterly income, YLD delivers that. But its baseline payout, roughly 5 cents a year, is stable rather than spectacular. You should also be clear about what's guaranteed and what isn't. That extra 3 cents special dividend boosted the trailing yield nicely, but it doesn't happen every year and shouldn't be treated as a sure thing. Then, there's the question of regional diversification. If you'd like your income to come from beyond Singapore, from places like Japan, Australia, Hong Kong, and China, YLD offers that in one neat package. And finally, ask whether you already own banks, REITs, or REIT ETFs. YLD works best as a complement to your core dividend pillars, not a replacement for them. Think of it as adding one more reliable tap to your copy money pipeline. Consistent, useful, but not the only source you depend on. Final thoughts. YLD is a clean, straightforward quarterly dividend ETF built around some of the most powerful financial giants in the APAC region. Its 6.2% trailing yield is certainly eye-catching, but realistically, your forward expectation should sit closer to 3.9%, unless the fund dishes out more special dividends in the future. If you're looking for steady quarterly income, a bit of regional diversification, and exposure to Asia's strongest banks, YLD is absolutely an ETF worth taking a closer look at. But no matter how attractive an income product looks, the golden rule remains the same. Stay diversified, stay steady, and focus on becoming cash flow rich, not just paper rich. If this full review helped you understand YLD better, like this video so more Singaporeans can learn about dividend investing, and subscribe to Wealth for You for more Singapore-focused income content every week. This is Wealth for You, helping you build the kind of income that lets you enjoy your kopi with real peace of mind.